Hello everybody, this is AK. I'm back. So not so long ago, maybe just a few days ago, I made a video on how a friend asked me if he should invest in CapitaLand Ascenders REIT, right? And because he had some spare cash, right, that he won in a lottery, right? And if you haven't seen that video yet, I'm going to place the link in the description box below so that you can watch it. And maybe you want to watch it first and then come back to this video, then you have the background, the backgrounder to this video, right? Of course. And in that video I compared Ascenders REIT as an investment. I compared it to the banks and explain why I was not interested, right? So Ascenders REIT, in that video I said was trading at 1.2 times book, 1.2 times book value, offered a distribution yield of 5.4% and had 20 times, and was trading at 20 times PE ratio. Right, so I said all that look rather unattractive to me. It's trading at a premium to book and 5.4% yield and 20 times PE ratio, which is very, very high, right? So I said I wasn't interested. And that the banks look more attractive to me, right? Also paying what 5 something percent dividend yield and trading at a similar premium to book if you're talking about OCBC and UOB. And in fact, OCBC is probably lower than 1.2 times book, right? And single digit PE, right, for OCBC and UOB, like 9.4 times PE ratio, right? So it just looked very expensive, relatively speaking lah, for when you talk about Ascenders REIT. Then of course Ascenders REIT also had a gearing level of like 37.4%, so it has debt of like gearing ratio like 37.4%. Then the same friend, I think he has gone back to talk to the broker, asked me about Keppel, right? Keppel Corporation has a stable of REITs. And whenever people ask me about Keppel REIT, I just get PTSD lah. Back in the days when it was known as K REIT, right? I still remember when it bought Ocean Financial Center, and they had to do some financial engineering in order to make the deal attractive, and unit holders had to cough up more money basically for that deal. And they had to have like rental support or something because their property wasn't mature yet, right? So it just gave me the impression that their REITs are where they dump the assets. It's just an impression that I get. I could be wrong. But anyway, history aside, my own bias aside, yeah, it could be a bias, right? So my own bias aside, if we look at Keppel DC REIT, right, which is one of their REITs, if I wasn't interested in Ascenders REIT that had a PE ratio of 20 times, I wouldn't be interested in Keppel DC REIT, which has a PE ratio of 25 times. And Ascenders REIT was trading at 1.2 times book value, right? Keppel DC REIT is trading at 1.6 times book value. 1.6 times book value. And all that to give you a distribution yield of 3.9%, which is lower than what Ascenders was offering, like 5.4%, right? And on top of that, their gearing level is higher at almost 40%. Ascenders REIT was at 37.4 or 37.5%. Why would I be interested in Keppel DC REIT? I know there's all this hype about AI and how they all need data centers, and data center is a thing to invest in, etc., etc. But I believe all the money was made by the people who got in much earlier. Right now, if you want to get in now, you're paying a very high price, right? I mean, people pay a high price for AI company stocks, right? And they have P ratio, sky high P ratio, right? But those AI companies, they could be making a lot of money, growing their earnings at a fast pace, and maybe that justifies the higher valuation. But when you own real estate and you are paying 25 times PE ratio, 1.6 times book, and you get 3 point something percent yield, I just don't see how that can be attractive. Imagine you were to buy a property and the seller say, I want to have a 60% above valuation. 1.6 times book. Would you pay for that? Would you pay that price? I mean, that's putting it in very layman terms, but that's what I am, right? I'm a layman. Keppel DC REIT. Then, of course, the other REIT that Keppel has is Keppel REIT, the commercial property REIT, the office REIT. Right, and if you look at Keppel REIT, well, it's more like a Sanders REIT. I know it's 20 times PE ratio, but it seems cheaper in the sense that it's trading at 0.7 times book instead of 1.2 times book, which was what a Sanders was trading at. And it's offering 6.3% yield. 6.3% distribution yield. So say, wow, then this Keppel REIT looks like okay lah, compared to a Sanders REIT, it seems more attractive, and compared to Keppel DC REIT, it seems less expensive and more attractive. Well, that's not the whole story, right? If you look at Keppel REIT, their gearing level is almost 42%, right? Almost 42%. So they are able to give you a higher yield because they borrow more money to invest with. So there is that thing to consider, right? So again, I'm not that interested in investing in REITs now. And like I say, if you haven't seen that video where I compare the banks and the Sanders REIT, you might want to go and watch it. The link is in the description box below. They just don't seem to be very attractive to me, right? Entities which borrow a lot of money to buy real estate, and they have to distribute 90 to 100% of their income in order to give you the distribution yield that they give you. I just, in the current day environment, you have to demand a lot more from REITs if you want to invest in them. And I think 3 point something percent yield from Keppel DC REIT 100% doesn't cut it for me. 5 point something percent from a Sanders, no, yeah. And 6.3% from Keppel REIT, well, is better than the Sanders, but it's on the back of higher gearing. So again, no. Yeah. So if AK can talk to himself, so can you. Bye-bye.